What I was going to just tell people is that you and I have chatted quite a few times, and that the most interesting thing about your syndication to me is that it's in two parts. So you kind of get the best of both worlds without having to, and you can hop out if it starts to make you uncomfortable. So I know the first 3 years are new development with the 15% preferred, and then you can roll into the next phase, which is the stabilization with an 8% preferred. So I find that fascinating to have kind of two funds in one. So I will leave it to you from there, and you can take it away.
Awesome. Thanks, Heather. Yeah. So, we've had, quite a few conversations, and they've all been enjoyable. So, I think, Kent's probably in good hands if he's your client. So hopefully he agrees with me.
Yeah, I did quite a bit of research just in general after speaking to Heather. Heather gave me and my wife Melissa a really great overview of syndication overall, and we're super excited and anxious to hear what you all have to say.
Good. Yeah. So I'll just go ahead and assume that most people that watch this are only mildly familiar with syndications. So first, I'll just kind of give a high level overview of syndication in general and some general thoughts about that. And then I'll just, as an example of syndication, I'll just talk about the specific deal, which is a little bit unique, like Heather said, because there's kind of two different parts to it. But I think it gives you a good flavor of syndications in general. So for those of you that don't know me, which most of you won't, my name is Isaac Schaefer. I'm a partner with REM Capital. We are a multifamily syndicator that focuses on the Southeast, Texas, and the Midwest, and the Midwest mostly centered around Ohio. We have a total of about 500 million in assets under management as of last year. As a company, we've been around since 2018. However, most of our team has been around for much longer than that. Robert Ritzenthaler, our principal, has been in real estate since, he likes to say he was in real estate for his whole life because his dad was a custom home builder in Dallas. But from a career standpoint, he started in real estate kind of in 2000. So he went through 2001, went through 2008. He cut his teeth in commercial real estate in New York during that time, and kind of saw how to navigate the great financial crisis, and they did it very well. They went from about 100 million to 1.5 billion in assets under management while he was there. And then after that, I think it was in maybe in the 2010, 2011, I believe, somewhere around there, he left that partnership and then worked for a public REIT where he managed directly managed $1 billion in assets around the Tampa area, and then also oversaw $4 billion in assets in kind of over their entire Southeast portfolio, as well as in some other MSAs as well around the country. So Robert has an incredible amount of experience, but REM itself is relatively young from a real estate standpoint, really only 5 years old. So syndication in general, and by the way, we only focus on multifamily. And that's basically all we do, mostly B and C class, as well as some development as well. We like to say we like to find C class properties in B class neighborhoods and B class properties in A class neighborhoods, and kind of bring them up to where they're supposed to be, add that value, add that NOI, which is really what drives the value of a property, and then create value by driving NOI. So that's kind of the playbook, is basically buy an asset, increase the NOI, which massively increases the value. One of the most important things to understand about real estate in general from an investment standpoint, and especially about syndications, is the relationship between NOI and cap rates. There's too much there to get into now, but basically cap rates kind of give you a multiple on NOI. And so if you increase the NOI, by 10 or 20%, you're actually increasing the value of the property by more than 10 or 20%. And so that it's NOI and cap rate is a very powerful relationship that you really need to understand as a real estate investor. And so that's really what we do. We buy properties where we have a really, really good line of sight to massively increasing the NOI, which sometimes doubles or even triples the entire value of the real estate itself. And normally that's about a 3 to 5 year business plan in order to actually accomplish. Thank you, Heather. Yeah, net operating income is what NOI is. And yeah, normally it's about a 3 to 5 year business plan to actually execute that increase of NOI. And we do that through a couple ways. Our primary way that we like to increase NOI is just through operating the property better. Ultimately, when it comes down to it, our secret sauce is REM is a really, really high class, well-run property management company. Because you can take the exact same asset and not run it as well and make half as much money. And you can take the same asset with a really, really good operator and make double the money. And that's where we really like to focus our efforts. And then, of course, there's, renovations, making it look nice, those sorts of things. Those things definitely add value, but the most value that we really like to look for, our main game plan, is to take a property that's being mismanaged and then manage it well. And that's kind of what you will see in all of our value add assets, is assets that have under market rents, sometimes by 20, 30, 40% in some cases, because they're just not managing it well. So we go in there and oftentimes can automatically, over a year and a half time, increase the rents to market, bringing up that NOI by 20 or 30%, simply just by pushing market rents, getting the bad tenants out and putting bad tenants in, and not even touching renovations. And so that's a really, really good way to add a lot of value to the property with a lot of sweat equity and a lot of headache from our operations team, but not a ton of capital in. And so that's kind of one of the things that we do. One of the main things that we look for when we're looking at properties, when we're looking at projects. And so ultimately our vision is to have a expert syndication business, a high quality institutional level run business, but still bring in retail investors, because there's a little bit of a niche in the market where people that run their businesses like we run our business, and with the quality and experience of people that run our business, most of those syndicators basically take institutional money, funds, family office money, but they don't deal with normal retail investors that have been successful for themselves, accredited investors. But they don't have, they're not writing $2, $3, $4, $5 million checks, every time. And so we want to, and then there's people that only take, 10, 20, 30, 40, $50,000 checks, but they're not as experienced. They're not that kind of high class, absolute professional, rock solid operator. And so there's a little bit of risk there. We like to kind of sit in that middle ground where we have an exceptional team, but then we also create opportunity for people, for normal retail investors to participate in that. And so that's part of the vision of the company. Another thing that I think I want to say about syndication in general is that the greatest risk for any syndication is in the operator, not in the asset itself. Because you can take a really, really good asset, and with a poor or inexperienced operator in the wrong environment, buying at the wrong price with the wrong business plan, really run that asset into the ground and turn what could be a really good investment into a bad investment. You take a really good operator with that same property, and you can turn a money losing opportunity into a money making opportunity. And so whether that's with REM or whether it's with somebody else, don't just look at the deal. The deal is the second thing that you look at. You absolutely have to vet the operator first to make sure that the operator has a good track record, is of absolute high character themselves personally, and how they treat their investors, how they think about their investors. We just posted a story several months ago on our LinkedIn, and we sent out an email about it. There was a syndicator in Texas who was about the same size as us. They had about 350, 400 million, I think, in assets under management. Things started to go south. He had a capital call, which basically means that you're kind of forcing your investors to put in more money. Otherwise, they'll get diluted, which is not something that REM ever does. It's actually legally written into our documents that we cannot have a capital call. And so he had a capital call from his investors, and then he saw the writing on the wall and knew that all of his properties were going to fail. And he took all that money from the capital call and tried to run out of the country. And this is a what people perceived as a high quality syndicator who had a good track record and good experience, but his personal character was not there. And
I
so,
know we've talked, if I can interrupt you for just a second,
yeah,
Isaac, I
please.
know we've talked a little bit about this, the fact that you guys guarantee no capital calls. Could you go into a little bit more depth about how you're able to guarantee no capital calls?
Yeah, it's very simple. It's literally written into our legal documents, our PPM, which is basically the PPM is basically our proposal to the SEC that we are able to issue an unlicensed or unregistered security. And so that's a legal document kind of codifying exactly what we're doing and explaining to the SEC why we don't have to register it, i.e., putting it on, on the stock market where, it's audited and other things like that. And this is a very specific carve out card called the Reg D 506C, which is what most syndications are. So in that paperwork and in our legal documents and in our operating agreement, which is just the legal document that governs what happens in each LLC, which these properties go under, is that we cannot make capital calls to our investors. And so basically what that means is that if for some reason the property starts to go downhill and more capital has to come in, that capital will not come from investors and investors will not get diluted. All that capital will come from us, the sponsor, or we will go out and find other debt to execute that plan, and that debt falls on the GP. The debt never falls on the LP. It does change the risk for the LP, but the LPs are never on the hook when it comes to debt liability. That's all on the GP. And so if for some reason that property were to go bankrupt, we're the ones that are on the hook for the bank, not the LPs. And so that's one of the important things about REM is that we will not make a capital call. And the reason why that's important is because that reflects in our underwriting. Because when we have properties come across our desk and we're looking at, okay, what are we going to make offers on? What are we not going to make an offer on? If we have in the back of our minds, and it's really at the front of our minds, several things, and I can go through some of those things because lots of them are important. But if one of those things is we're never going to make a capital call to our investors, that really makes you buckle down and make sure that when you are writing an offer on that property, that the offer that you write is not going to put you at risk for having to make a capital call in the future. And so the assumptions that you bring into your underwriting drastically change what projects you actually enter into. And so from REM standpoint, one of those things is we're never going to make a capital call to our investors. That massively changes our underwriting and is reflected in, all right, what sort of investments are we going to make and what sort of safety is going to be behind those investments. The second one is that we pro forma all of our projects to be a 5 to 10 year hold. And so that means that we are setting the expectation for our investors that we're going to hold these properties for 5 to 10 years. Now, that's probably not going to happen. Most likely somebody's going to come along at some point in that cycle and offer us more money than the property is worth. And so we'll take the check because that's in the best interest of everybody. But that's our underwriting. We underwrite a 5 to 10 year hold. What we don't tell a lot of people is that in our internal underwriting, when we're actually looking at a deal to see if we're going to put it forward to our investors, we're actually underwriting for 15 to 20 years. And so that means that when we're looking at an asset, we need to be comfortable holding that asset for 15 to 20 years before we ever even consider making an offer. And that makes our time horizon long enough to where, okay, we're not just banking on capital appreciation. We're not just banking on this market being hot and the value of our property appreciating just because it's in a hot market in order to make money, because you can't do that in 15 to 20 years. We are underwriting so that the properties that we enter into, just from a fundamental basis, as long as the US and our economy doesn't completely tank back to Great Depression, Great Depression levels, which, some people think that's going to happen. It may or may not, who knows? But if that happens, we have more problems on our hands. But we are underwriting so that we are comfortable holding this asset, even if there's a recession, and we are still able to make money and especially not lose money, even if we have to hold this for 15 to 20 years. And so those are some of the assumptions that we bring into our underwriting, which is reflected in the types of assets that we buy, and the safety with which we buy them. Another investing term that we like to use is margin of error. You know, what is your margin of error or margin of safety? In other words, what have you baked into this equation as far as, you know, making a decision about what asset to buy and what assumptions you're making? How much margin of safety do you have before your mistakes or being wrong about those assumptions actually starts to hurt you? And so we like to have a large margin of safety in all of our deals, because we know there are things that are going to happen that we can't predict, tenants that we can't predict, all of these things. And so we bake in enough margin of safety where we can be surprised by several things, but it doesn't actually end up hurting us in the long run, because we've baked in enough margin of safety into our deals. And so those are some of the things that you need to look for, whether that's with us or whether it's another syndicator that you're looking at investing in. All of those things should be in place before you ever consider investing with them. Now, maybe your investing style is you want to invest in something that, you know, is a really hot market. You're in and out within 18 months and it's real quick, high returns, etc. You just need to understand that that's not so much real estate investing, that's real estate speculation, and it's much higher risk of losing your money. And that's, in my opinion, the way that I view real estate, that is a misplacement of an investment in real estate. If you want to go make 5-10x your money or something in 18 months, go invest in the stock market or invest in some private businesses or moonshots or things like that. Don't do it in real estate. That's not what real estate's really for. So anyway, I know there's people that make money that way. Good on them, but you just need to understand that it's not, you know, just because you're investing in real estate doesn't mean it's a safe investment. You can speculate in real estate every bit as much as you can speculate buying a penny stock or some pot stock or something like that. So that being said, any questions so far? I feel like I probably need to actually get into the actual deal now, but.
No, I think that was a good overview though. Kent, do you have any questions?
No, it's very clear. It's I like the approach. I actually speculated a couple of years ago, didn't work out so well for me. So I definitely have that experience.
Yeah. We all do. You know, we all we like, as humans, we like shiny things sometimes, and sometimes it gets the best of us and we convince ourselves that, you know, something might be safer than it actually is. So it's always good to check those assumptions. So yeah, all of that being said, I'll just kind of go back to kind of REM now and speak less broadly. Primarily over the last 5 years, we have bought value add assets, solely value add assets, actually. So we're going out, buying a property, renovating it, you know, increasing the rents, turning over bad tenants, bringing in better tenants, etc. With the way that the interest rate environment and the economic environment has gone, costs, things like that, value add deals don't really pencil right now, at least with the way that we underwrite them. It is very difficult to buy an existing property and have there be enough meat left on the bone and buy it cheap enough to where we can execute our business plan and be confident about the product that we're offering to our tenants and the investment that we're offering to our investors. So because of that, we've pivoted a little bit, at least this year, to some development properties. We've been able to buy up some vacant land for pretty cheap, about 20 to 30%, sometimes more under market, just because of some relationships that we have. We bought them off market. And so for St. Pete, for instance, which is one of the developments we're doing right now, in St. Pete, the current market cap or the market cap rates for St. Pete right now are about 4.5 or 5. Okay, that's pretty low. St. Pete's a pretty hot market. That's what you would pay if you were buying an existing asset. We are building 220 units in downtown St. Pete. It's a couple blocks away from the Tampa Bay Rays Stadium, 17 minutes away from the #1 beach in America. We're building 220 units for a 6.5 or a 7 cap. And so we are building these assets a whole lot cheaper than we could actually buy them, you know, existing. That's a really, really good place to be, especially in a super hot market like St. Pete. So St. Pete isn't just a hot market right now. They've had 5 to 6% rent growth for the past 10 plus years, and studio apartments have had 11% rent growth year over year for the past 2 or 3 years. 5% rent growth is about 50 to 60% above the average rent growth for the rest of the country. 11% rent growth is, you know, a couple 100% above the rest of the rent growth for the rest of the country. So, and that's been a really sustained increase in the market in St. Pete. So St. Pete's an amazing market. And even during COVID, when we saw a little bit of cap rate increase, just because the value of property was going down, people weren't paying rents, people were uncertain about the economy. And so the value of assets, of multifamily assets, started to go down a little bit. St. Pete's cap rates went nowhere. They stayed nice. They stayed really low, which means that they're valuable. Low cap rate means more valuable. Low cap rate's a higher multiple on your net operating income. And so St. Pete's a great market to invest in. The benefit of doing development right now in St. Pete versus value add is we're able to build 220 units for much cheaper than if we were to just buy them and try to, you know, renovate them and turn them over. So from the deal standpoint, 220 units, technically on 2 separate parcels, 2 separate properties that are about a mile away from each other. About 70% of them are studios. The last 30% are 1 bed, 1 bath apartments. Heavy on the studios because there's actually a pretty significant deficit in studio apartments in St. Pete, hence the 11% rent growth year over year. And also because the 1 beds and everything is getting so expensive, people are realizing, well, I don't want to pay $2,500 for a 1 bedroom apartment. I can fit in a studio. I'll just fit in a studio and you know, save $500 a month. And so there's a lot of that going on in St. Pete just as rents keep increasing. And so that's kind of our strategy around more studios. Additionally, you can just fit more doors on a given parcel of land. You know, you can fit, you know, 2/3 as many studios as you can, you know, 1 bedroom apartments on the same parcel. So just getting a little bit more bang for your buck that way. So basically the strategy is to build these units. And then we expect that to take about 18 months. It's shovel ready. We're basically ready to go. So as soon as we have enough equity in to close on the construction loan, we're able to start building. And so it's about 18 months to build the units. And then we've proformed 18 months to lease them up to where they're 90% leased. I think that's probably extremely conservative. I bet we could probably do it in less than 12 months if we're being honest. So, but that's kind of what we've
lease it up in less than 12 months, you mean?
Yep. Yeah, I bet we could lease it up to 90% in less than 12 months, just with the way that the market is. We have a really, really solid team to be able to just crank it out and get those people in there. So during that 36 months of construction to lease up, investors will be earning a 15% pref. So that means, just to make math easy, if you put in $100,000, that means you are accruing 15% every year, and it's accrued, but it's not compounding. So it's accumulated, but not compounding. That means that every year you're accruing $15,000 that's owed to you. So in year 1, $15,000. In year 2, it's not 15% on $115,000. It's still just another $15,000. Okay, so it's accrued, but not compounding. So again, so 15% pref from the start of construction until it's 90% leased up. Once it's 90% leased, we'll do a refi because we have added massive value to the property, probably about 2.5x-ish what we originally paid for the land and for our construction costs. And so at that point, we will do a cash out refi, and we will use that extra cash to do 2 things. Either 1, roll it over and just have more equity in the property, or 2, for investors that want out of the deal. So say it's been exactly 36 months. That means that you have accrued $45,000 for every $100,000 that you invested. You can take that $145,000 and walk. and you're done. You made your 15%, you're happy with that, and you're out. At that point, you would pay capital gains on that $45,000. Okay. And it will probably actually be a little bit more than that because you do own equity in the property. It's not a note, it's preferred equity. And so you actually get equity in the property as well. So it's probably going to be a little bit more than 145, but we'll just use that for an example. So you can walk with that 145, you pay capital gains on the 45 and you're done. Or you can take that 145 that you've earned, or the 45,000 that you've earned, and roll your principal and what you've earned into the stabilized portion of the deal. Okay, so now we're leased up, everything's stabilized, property is humming along, we're doing really well. And at that point, you would make an 8% pref and a 50-50 split for everything over 8%. Okay, but that's on your 145,000 and not on your 100,000. Okay, so you've basically increased your basis, increased how much you're earning, because you've been patient and you've sat there and let your money accrue over 3 years. At that point, so say you have $145,000 in the deal and you're making 8% pref and a 50-50 split after that, based on where we're performing our rents at, you'd be making about 15 to 20% per year on your original investment. So that means that if you've invested $100,000, you'd be getting a check every year. Well, 12 checks because we do monthly distributions, but you'd be getting $15,000 to $20,000 every year, clicking off like clockwork, starting at that point. And then if we ever sell the property, you get all your principal paid back, and you still own 50%. Investors own 50% of the property itself, 50% of the equity. And so any profit from the sale of the property, you would also participate in that as well. So that's kind of the high level overview of the deal. And so we've pro forma'd basically 3 years, 36 months for construction to lease up. And then we've also pro forma'd a sale of the property in year 7. Just because in order to put an IRR on it, you have to have a sale. And so if that's the case, the IRR for this particular deal is about 25 to 30%, about a 2 to 2.5x multiple on your money.
So you're looking at monthly checks around 966, like ballparking. If you have put $100,000 in originally, with the increased equity, you're making 8% a year cash flow. So you're looking at somewhere around $950, $1,000 a month, but maybe more depending on how it's performing. Does that sound right?
Correct. So most likely it is going to be more because so the way that, for those of you that aren't as familiar with syndications, the way that we call them waterfalls, the way that waterfalls work is, so say in the 8 pref 50-50 split example. So say you've made it through the 36 months, you rolled it over. The way that preferred returns and splits work is that investors with the 8% pref, investors receive 100% of the cash flow until they get up to an 8% return. Okay. After the investors meet that 8% return, it's also called a hurdle. So after investors meet that hurdle, any cash on top of that 8% is split 50% to investors and 50% to REM. And that's the only way that we make money, really, is after we get you past that 8%, that's when the REM starts to make money. And so what that does is that aligns our interest, because that property has to perform above 8% before REM starts to make a penny. Okay, except for the management fees that we pay, and that's just property management. So that's above the line anyway. That's an operational cost just to operate the property. So that's how waterfalls work. And so most likely in that scenario, so say the property itself ends up returning 14% for the year. That means investors make the first 8%. And then the remaining 6% is split 50-50 from REM to investors. So that means that investors get 3%. So for that year, investors will make 11% and REM will make 3%. And so that's how that waterfall would work. Now, that doesn't happen nice and cleanly at the end of the year. It's all, because we're sending out monthly checks, that all happens throughout the year. And so investors get 100% of the distributions until they get up to 8%. And then if there's once distributions get above 8%, then it's split 50-50, if that makes sense. And so if you get to 8% by, say it's, we're starting Jan 1, if you get to 8% by July, so you've already made your 8%. Now from July on, your everything is split 50-50 between investors and REM. So
you might actually be getting larger checks for the first half of the year.
Technically, yes. Technically, you could be getting larger checks for the first half of the year. Yeah, theoretically. But again, that's kind of like you've already made your 8%.
Right.
And now it's everything on top of that is because you own 50% of the property. Investors as a group own 50% of the property. So.
And then that starts over again the following January 1,
Yep.
right?
Yep, exactly. That starts over again January 1. And that 8% is based on the principal that you still have in the deal. So that's another thing about waterfalls is that, so say you, just to make math easy, say you have $100,000 of principal into the deal. Paying back the pref does not affect your principal. So if all you get in a given year is 8%, that means starting Jan 1 of the next year, you are still making 8% on your $100,000. But say for a given year, rather than returning you $8,000, which would be your 8 pref, you actually get returned $10,000 because you experienced some of that split. Now your principal is now $98,000 instead of $100,000, and so now you're earning 8% on $98,000. Okay, so pref is not realized against your principal, but split is. So once you get above that 8%, anything above that 8% is basically a payment back to you off of your principal. Okay, and then starting the next year, whatever your principal balance is what you're earning that 8% on. Does that make sense?
Yeah, so you may be reducing your principal amount, but your equity position remains the same.
Yes,
so
exactly. Yeah,
you
your equity
principal,
remains the same.
Okay, so if your whole principal's paid down, now you're just getting 50-50 cash flow and you're putting that money to work somewhere else.
Exactly.
Okay.
Yeah. So once all of your principal is paid back, then you're just sitting, now you're just playing with house money, basically. All your principal's back and all your pref is back. So that's another thing. In order to get all your principal back, all your pref has to be caught up first. And so, because that's what happens. So in the instance of a value add deal, which is mostly what we do. So most of our value add deals just start from the gate at an 8% pref, 50-50 split. That's how those deals are set up. The way that we structure those deals is that kind of business plan of 3 years of kind of executing renovations, raising rents, that sort of thing. That business plan normally takes 3 to 4 years. And that 3rd or 4th year, we do a refi event, almost the exact same as St. Pete. And because we've increased the value of the property, and so we take a cash out refi from that increased value of the property and pay back investors. The first thing that money goes to is paying back any pref that is owed to investors. So say we actually owe you 12% instead of 8%, because if we don't pay you 8% in a given year, so say we just pay you 4% in a year, because we're turning over units, there's higher vacancy because we're executing our business plan and turning things over. So say we only pay you 4% in a given year. That means the next year we now owe you 12%. Okay, because you have your 4% that rolled over from the last year and your additional 8%. That means that investors make 100% of the distributions until you get to 12%. And then only after that is there a split. Okay. And so that's kind of how those deals work. And so only after, the reason why I mentioned that, now I remember, the reason why I mentioned that is because the only time where your principal can start to get paid back is if you are completely caught up on all of your pref. Okay. And so no matter what, you're going to be making your pref before you start paying back principal. Does that make sense? So it's whatever the pref is, it's going to be 8%, 12%, 15%, whatever the pref is for a given deal.
Okay. And this is all capital gains. Everything that we get from this deal, tax wise?
Everything above your principal is considered capital gains. Yes. The preferred return, caveat, disclaimer, I'm not a CPA, so take everything I say with a grain of salt. The preferred return that you get, that is considered, as you're getting checks throughout the year, that's just considered passive income. Okay. Capital gains really only occurs if the property were to be sold. Okay. So say even in the event of a refi, so say it's a value add deal, we've executed our business plan and we've raised the value of the property, and we do a refi and pay you back all your principal, and now you're sitting on house money. Us paying you back your principal oftentimes is not a taxable event, because now you're just back to zero on your capital account. The preferred return,
that makes sense. I mean, like, I'm giving you, I mean, that
exactly. Now any preferred return that you would have gotten, that's considered passive income. And then if we were to sell the property in the future, now you're talking about capital gains at that point. Again, not a CPA. Talk to your CPA about your personal financial situation.
Also not a CPA here, but what about, but you also do get to participate in the depreciation of the asset, right? So you would have some passive loss, you would have some passive income, there would be some offsetting likely.
Exactly. Yeah. Thank you for mentioning that, Heather. So in all of our deals, we always pass on depreciation to our investors, and we also always do cost segregations. So that's one of the best things about commercial real estate, is that for right now, the IRS is allowing us to do cost segregations and take accelerated depreciation. So on something like St. Pete, we can't do that yet because the structure doesn't exist yet. But once we get our certificate of occupancy, at that point, you can do a cost segregation and accelerate that depreciation schedule for, whatever they will allow you to do. And that gets passed on to investors. So in like our value add deals with an existing property. So we just did one, what was the last one we did? We just did one in Orlando last year. We closed it at the very end of the year. That property, and last year we could still take 100% depreciation, 100% accelerated depreciation. For 2023, the IRS has decreased that to 80% accelerated depreciation. So it would be less this year for the same deal. But last year we were able to take 100% accelerated depreciation. And on that property, investors saw a 70% loss on their K1. So that means if you invested $100,000, your K1 actually showed that you lost $70,000. So you're basically, up on your investment starting already. So $70,000 loss, you're talking about, $30,000 to $40,000 net that you just saved on taxes, theoretically. And so that's something that we definitely pass down to investors. The other thing from a tax standpoint is it's basically a handshake agreement. We can't necessarily do this in a contract, but it's basically a handshake agreement with all of our investors that if we ever sell a property, we will always offer the ability to 1031 exchange into a new project. Okay, so we are extremely sensitive to the tax situations of our investors, and we fully intend to allow all of our investors to take advantage of all of the tax benefits of owning real estate. One of those things is depreciation. Another one of those things are 1031 exchanges. So stepping up your basis into a new project. And so we basically have a handshake agreement with all of our investors. If you invest in one of our deals, we will always offer you the opportunity to roll that investment over into a 1031, into a new syndication, into a new project. Now, if you don't like us at that time, or you weren't happy with your experience, you can always take your money out and pay capital gains. That's no problem. But we always make sure and offer that to people just to take advantage of all of the tax benefits of real estate.
Do you recommend doing a new LLC per deal? Like, we already have an LLC. Can I just use that for everything?
You can. I would say creating a new LLC for every syndication, for every investment, if you're just doing it yourself, or even with the same group of people. If you have the exact same group of people and everybody's putting in the same dollar amount and the ownership doesn't change, then there's no reason to create a separate LLC for every different investment. The reason for that is because it doesn't really provide you any extra protection. Because, the reason for an LLC is because it provides you, protection. The reason why that doesn't really help you in a syndication is because LPs, by the nature of being an LP, a limited partner, are not exposed to debt risk, and they are not exposed to physical liability, which are, part of the reasons for the main reasons for doing an LLC anyway. Now, if you want to spin up an LLC because you want to have, 4 or 5 people come in and kind of pull your money together and invest, no problem at all. But just to give yourself extra protection, there's really no reason to.
And I guess if you're doing, let's say I'm doing several syndications and other deals, that there may be a benefit to one not doing so well, or more depreciation helping back and forth the ones that are really killing it, right? So you could balance off your.
Oh, absolutely. Portfolio. Yeah, absolutely. So yeah, when you get depreciation anywhere, or capital gains anywhere, because it all flows down to you as an individual, your CPA can manipulate that however they want to. Oh, well, we got.
I have one living in my house, my wife.
Yeah. So we got 50,000 of passive income over here. Oh, well, we got 70,000 of depreciation over here. Cancel that out. That extra 20,000 carries over into the next year, and you're good to go. So yeah, okay. Absolutely.
And the minimum on this one is?
Yeah, so minimum for basically all of our investments is 100,000. And we require that every individual be an accredited investor. And so that means if you're doing an LLC, every member of that LLC also has to be accredited. So it can't just be the managing member of the LLC to be accredited. Every single person within the LLC, because it's a pass-through entity, has to be accredited. And just for those of you that may or may not know, accreditation is very simple. It's not something that you apply for. The only thing that determines whether you're accredited or not do you have a personal income of $200,000 for the past 2 tax years, or a household income of $300,000 for the past 2 tax years, or a total net worth greater than $1 million, not including your personal residence. If you qualify for any of those 3, you are automatically an accredited investor. You just need in order to participate, all you need is a letter from your CPA or from your financial planner or a broker dealer. There's certain people that can actually certify that you're accredited. You just get a letter from them that says that you're accredited, and you can invest. There's other things as well, like a business that's worth over $5 million can count. A trust that's worth over $5 million can also count, make you an accredited investor if you're the trustee. Several other things, but those are the 3 main ones. Okay. 200,000 or 300,000 or $1 million total net worth, you're an accredited investor.
Gotcha.
And what's the process, Isaac, if someone was like, you know what, I'm really interested, I'm gonna think about it for a day or 2, and then I want to move forward, how would they go about doing that?
Yeah, so really all you need to do would be to reach out to me, and Heather, feel free to distribute my information to anybody. Actually, I can throw it in the chat too. Just reach out to me, or you can reach out to Greg, and we can answer any questions and walk you through the process. And then ultimately, so say, yep, I want to invest. What we do then is we give you access to our portal, which is where you can go on, electronically sign all the documents. It takes like 2 minutes. And then you also connect your bank account, and you can directly wire money into our bank account and set up an ACH, because then what happens is if you set up your ACH with your bank account, monthly distributions will just go directly into your bank account. We'll just dump it into you, so you don't have to worry about checks or anything like that. And so that's basically the process. And then at that point, once you invest in a deal, you'll get monthly updates on the property. Like, hey, this is how many vacancies we've had. This is how many units we turned over. These are the rent bumps that we're getting, all those sorts of things. And so you'll get monthly updates along with your distributions on how that property is performing. And then you'll get a K1 at the end of the year as well. So really relatively simple. It's signing up for our portal, which is, username, password, sign a couple documents, wire the money, and then you're done.
Awesome. Does anybody have any more questions for Isaac?
No.
Letting off easy.
Yeah. I guess the only other thing that I'll say is that we do have a VIP program for investors, is that if an individual investor or an LLC invest more than $1 million at any point, cumulatively, from that point on, any other investment that they have with us, they'll get a 60-40 split instead of a 50-50 split. And so that's just, you're a loyal investor, you stuck with us, you've invested a lot of money with us, we're going to give you a little extra juice. So that's another thing to keep in mind. Again, that's either for an individual LLC, as long as it's the same LLC that's invested $1 million, or for an individual themselves. And we have, quite a few people that are in that boat. So that's just another thing to think about.
Okay. Anything else, Isaac, or feel like you covered everything?
I feel like I hit the highlights. If anybody wants like a real deep dive into St. Pete itself, there is a webinar that we hosted that kind of goes through an entire deck, goes through all the details, most of our underwriting on the deal. And that's something that I've provided to Heather, and Heather can distribute to you, or you can reach out to me and I can get that to you. And that will kind of give you a more detailed overview of St. Pete in general. But I'm also more than happy to have personal calls with anybody to kind of walk through that and talk through that as well. So I just I wanted to stay relatively high level and make it as educational as possible for today, and just kind of give people an example of the sort of things that we do.
Yeah, this was great. Really appreciate your time, Isaac. Sorry about the confusion with our other classes that are going on at the same time, but
No
this
problem.
recording will get out. And I just want to say for everyone's reference that I have had several personal calls with Isaac. You never feel like you're wasting his time if you just have some questions. He's more than happy to schedule a little time with you and talk through things. So I recommend, if you do have those questions, that you just reach out to him and have a little conversation.
Yep. And you can get my email from Heather. And then I have a scheduling link in my signature where you can just go on, book some time with whatever works for you. So it's really slick and easy. So.
All right. Well, thank you, Isaac. Appreciate your time.
Thank you very much.
Greg, it was nice to meet you. And I'll see everybody soon.